Welcome to the Master of Science in Real Estate. My name is Douglas Kahn. The course will take approximately 10 hours. It doesn't mean that we'll have 10 hours straight of video, but there will be 10 hours of material roughly, and you'll probably need some coaching, and I'll have some short exercises for all of you to do. Just a little bit about the course. We're going to go through some basic finance, basic Excel skills, and real estate and finance terminology. I really want you guys to be able to dive right in as an analyst. There are many different kinds of real estate models out there. There's many different ways of doing it. The math ends up being basically the same. What you'll find is that there's a lot of companies have different specific policies. In my experience, I spent a number of years in accounting, and I worked at Newmark Knight Frank as an analyst, underwriting deals there. And I also worked in the prop tech sector, which is an interesting up-and-coming area. I created a piece of software called Rockport Val, or at least I was part of the team that created it. If you are familiar with financial analysis and real estate, you know that Argus is more or less the gold standard for financial modeling. Some companies don't want to use it. They prefer to use Excel, but it ultimately speeds everything up and it gives the industry a standard, at least for the mathematics. Sometimes the way that we used to do it at Newmark was we would use Argus and Excel. I'm also a RAM. I graduated Fordham Gabelli School of Business in 2011. I hold a CPA license and an MBA from Northeastern University. We're going to dive right in. So the time value of money is the most basic financial concept there is. It essentially means that money I get now is worth more than money I get later. Most of you know this instinctively. You know that if you wait a few years to buy something, chances are it's going to be a higher price. In investment analysis, we incorporate that as a discounted cash flow, which uses something called a discount rate to account for the time value of money. This part of the course has quite a bit of definitions, just to be warned. The discounted cash flow is a valuation method used to measure the value of an asset. It is a method of understanding the value of an investment today based on its cash flows in the future. So essentially what that means is I buy an apartment building. It costs me $1 million and it earns $100,000 a year, and I discount that to the present to figure out what it's really worth. Now, for your mom and pop investor, they usually just want to know dollars in, dollars out, the cash on cash return. Present value is the current value of a future sum of money or stream of cash flows at a specified rate of return. So, for example, on the next page, you'll find $1,000 a year at an 8% discount rate. The discount rate is what we use to express the time value of money and find the present value. Discount rate is a cost of capital. In corporate finance, it is also called the WACC, or weighted average cost of capital. In RE finance, real estate finance, it's called the OCC, or opportunity cost of capital. It represents the sum of the interest rate and the cost of equity. This is a very basic present value formula. Essentially, what the present value does is it accounts for the discount rate and the number of periods. Now, in this particular example, we have an 8% discount rate, and as you can see, the denominator is 1.08 raised to the period. So period 1, period 2, period 3, and that's what's called discounting. This page is meant to demonstrate what the guts of this formula looks like. So you have your cash flow here, then over 1 plus the discount rate, which is this 1.08, discount rate of 8%, and then raised to the period. In this particular case, we're just calculating the present value, not the net present value. The net present value is slightly different. it assumes usually an initial outlay at period 0. And in the case of Excel, what it's doing is Excel's NPV formula only takes into account present value. So when in Excel is different from the actual concept of net present value. Net present value is just the initial cash flow raised to 0. The present value of all the cash flows, and then you add back the initial outlay. In this case, $1,000, and then I assumed $1,000 coming in every year just for demonstration purposes. The formula is otherwise the same. This slide is meant to demonstrate future value and IRR. So the interest rate in this case is 5%, and each period your interest compounds. So the cash flow was $1,000, but you're always adding that interest. So the first interest you're going to get is $50 that year or period, and then it compounds because you're taking the interest on the 1,050 and adding it to that number, and it compounds each year. Now, as you can see, this is strictly the cash flow times 1 plus the interest rate raised to the number of periods. Now, R can be either the discount rate or the interest rate. The internal rate of return is probably the most important method of estimating returns in modern real estate finance. It really only came about after computers became widely used because it's a very complex formula to do. It's almost impossible to do by hand. What it is the discount rate that you need to bring the net present value of an investment to 0. It assumes that all of your cash flows are being reinvested in the asset at the same rate of return. It's not the same as ROI, return on investment. And the only way to really do it is to use the IRR function in Excel or a financial calculator. Types of leases. So gross lease and full service gross lease mean different things in different markets, but in general, it means a payment of rent only. Whereas in commercial leases, there's usually other payments involved. The tenant will reimburse all or part of the expenses on the space that he or she owns, leases. And these are described below. So there's NNN or triple net lease. This is a lease where the tenant pays rent plus a portion of the expenses on a net basis, meaning if the building has $100 in expenses and the tenant occupies 10%, the tenant pays $10. Modified gross is a structure that also has different meanings, but typically it's when a tenant pays a portion of a lease over a base year. So you'll see demonstrations of this in my Excel models later on. But for example, if I have a building that has $1 million a year in expenses and I have a tenant that occupies 10%, and next year the expenses for the building go to $2 million and the tenant's base amount is that original $1 million, there's $1 million difference, and you multiply that by 10% by the tenant's pro rata share. The base year stop is the base year in which the dollar amount of expenses is calculated. The lease commencement date is the start of the rent schedule of a lease. The rent commencement date is when the rental payments start. So in most commercial leases, and even in most residential leases, you will get a month or two of free rent. In commercial leases, it's more than that. It's usually 1 month per year of the lease. So if I sign a 10-year lease, I'll get 10 months free up front. Tenant improvement allowance, TIs or TIAs. This is a dollar amount the landlord gives to the tenant in order to build out the space the tenant rented. Leasing commissions. When a tenant leases a space, there's usually a broker involved who receives a commission, usually from a landlord. It's normally calculated as a percentage of the total lease payments minus the free rent, but some markets, specifically New York, have more complex methods. The free rent, landlords, usually, as I said, usually give a period of no rent. Sometimes there's some operating expense reimbursement involved, especially in triple net leases. The millage rate is the percent per $1,000 of a property's assessed value that generates the property's tax bill. Direct capitalization is the industry standard method for valuing real estate. It is used for the sale price, whereas the present value is used more for financial statement purposes and calculating depreciation. It is the net operating income divided by the value of the property. The value of we use cap rates to determine markets. So if a market sells multifamily at a 5 cap, it means that if I know the building's income, I can derive a value based on other transactions. In finance terms, the cap rate is defined as R plus G, the discount rate plus the growth rate. It's a way of calculating the terminal value of a property. Reversion is another word for the sale of the property. Cash on cash return is the measurement of an investment return that most of you are used to. It's if I put in $1 million and I'm earning $100,000 a year, that is my cash on cash return. I'm making a 10% return. Cash income earned from a property divided by the total cash investment. It's similar for ROI, though it usually excludes certain large but rare items such as major capital improvements and leasing commissions.